Just to put this point into focus, Nick, can you just throw up this chart? So this is basically what we're dealing with, which is like if you look at, and these are just a couple of examples, but this is Meta, Amazon, Snowflake, Datadog versus Gilead, Raytheon, and Exxon. What is the point of this? The point of this is just to show you that we have had a massive rotation away from our industry, is the point, right? Where normally the things that we would work on were just so well received by so many different kinds of investors that unfortunately just isn't the case anymore. And I think it just goes to show you that the reason why this is happening is because people are hedging their bets about how long the economic pain lasts. That's why, they'd rather be long healthcare stocks, industrial defense companies, and oil companies. Because at the end of the day, they're banking on oil and war and sickness, versus
social media and e-commerce.
No matter how good, by the way. So this is not an indictment on these companies.
Go watch the prediction episode from last year. I think
watch the prediction episode. Yeah, you and I nailed it on crypto. We both said crypto was going to crater. These four horsemen here: Datadog, Meta, Amazon, Snowflake down 23 to 27%, and then the Gilead, Raytheon, Exxon cohort 8 to 28% up. I think, Chamath, what this says also is we don't think your management style and how you're running these businesses is appropriate for this moment in time. Please consider some austerity measures and some thoughtfulness in how you treat shareholders. Vis-a-vis, well, I mean, it's just watching the number, how people are running companies. I think we took it too far in Silicon Valley. We took it too far.
I know it's sort of a pet issue of ours because we have to deal with some incredible hubris and arrogance sometimes on the boards of these companies because folks don't want to listen to reasonable advice and we come off as wet blankets. But that chart, to be honest, is because of what we explained last week, which is when rates go up, the value of $1 that you earn today is just meaningfully more worthwhile than $1 that you may earn even 2 or 3 years in the future. That's why that chart looks the way that it does. And if you believe that David's forecast of a double dip recession is accurate, which again, most of the sharps do, and then you also layer in this idea that inflation could come back, you have to be really defensively positioned. You can't take a lot of risk, which is why startups have to expect that if that's the dynamic and $600 billion is going to get destroyed in venture capital portfolios, how open are VCs going to be for business? They're probably not going to be that open. And so you have to plan, I think, for the early part of 25.